All righty. Hello, everyone. Welcome to the monthly OPEXEngine webinar series, SaaS Conversations. Each month, we discuss operational issues that are top of mind for SaaS finance leaders. I'm Lauren Kelley, CEO and founder of OPEXEngine, the leading SaaS benchmarking platform to compare your financial performance, your operational expenses in each department, headcounts, productivity KPIs, and compare against peers and market leaders in the software and SaaS world. Today, I'm really excited to discuss the topic of dynamic planning and what's changing and what's staying the same in 2023 with two great operational CFOs. I met Evan Meagher, CFO of CoreWeave, a couple months ago when he spoke before me recently at a Kane Partners conference. And I was blown away because he managed to, in 30 minutes, present everything that was important about budgeting. It was very impressive. And then I'm also incredibly happy to have Brian Weisberg with us, who is the CFO of Tidelift in our conversation today. Brian's been in and around the SaaS community and the OPEXEngine SaaS world for a couple of years now, I think. And I've always been impressed with Brian's curiosity, insights, and just really thoughtful approach to applying metrics to his company or really any SaaS company's performance. So I'm going to let them introduce themselves quickly and especially tell us a little bit about their companies so that we can better understand where they're coming from in terms of their business model. Let's start with Brian. Can you tell us a little bit about your company and then just one important thing about you, whatever it is?
Sure. Thank you for that introduction, Lauren. It's nice to meet y'all and be here, part of this webinar today. So I am the CFO of a company called Tidelift. You can see the name up here, like a rising tide lifts all boats. What we have at Tidelift is a solution that helps development teams manage the open source components they're using when they're building an application. So we fall into the dev tool space and kind of the DevOps or DevSecOps kind of niche or vertical. So from a commercialization standpoint, it's traditional enterprise SaaS. We sell on a subscription basis, mostly annual or multi-year contracts to mid to large size organizations, heavily focused on kind of like an enterprise sales motion. But one nuance to our business model where I'm especially interested to kind of dig into some of the metrics that OPEXEngine tracks has to do with a unique component to our model where we charge a subscription fee, but we also go and partner with open source maintainers as freelance contractors. We sign them up to actively maintain the open source components that they're already maintaining on their own. We just establish a commercial relationship with them. And so a portion of our cost of goods sold is effectively like a fractional engineering resource or resources. And so tracking things like R&D efficiency is super important to our business and really kind of understanding the nuances that roll up into gross margin or cost of goods sold. Makes it so that we can't just take off the shelf metrics and look at general benchmarks. We have to kind of really get into the weeds. One fun fact about me is that, I don't know, I started picking up skateboarding during the pandemic. My son, who's 10, wanted to pick up a new hobby, and I figured no time like the present to learn how to skateboard. A little harder when I fall than when he falls, but it's been fun to try and learn something completely new.
That is awesome. I love that. Gosh. So, Evan, how about you? Tell us about your company. It's also a little different from the standard SaaS applications company.
Sure. My name's Evan Marr. It does look like Meagher, but it's a mistake. Sorry, it's a mistake that my CEO makes on roughly 2/3 of phone calls, and I've worked here for several years, so I don't think it
must be a CEO thing.
Yeah, that's right. I'm the CFO of a company called CoreWeave. We are the fourth largest GPU cloud in the United States. You've heard of the biggest three. We are very many orders of magnitude smaller than the AWS, Azure, and GCP of the world. We primarily serve we have a number of use cases, but from a logo and revenue perspective, the largest two use cases currently our AI ML platform, so training and serving these large natural language models, some of which you've read about in the news. Some of those, without naming names, are running on the CoreWeave platform, and then also visual effects rendering. And we actually closed an acquisition of a company called Conductor Technologies that has relationships with a huge number of people in the Netflix ecosystem. So people working on the next Marvel movie or episodic TV shows for Hulu or Netflix or Apple TV or what have you. Other applications include, medical research, when you're folding a complex protein molecule on itself 500 million ways, and so on, for early stage drug development. But, by and large, those are the use cases. The one thing in common is that it's a really concentrated burst compute at scale. So, our CTO once joked on Bloomberg, like, we're not here for your WordPress blog. This is for really compute intensive stuff. An interesting thing about me, I played professional baseball in Europe when I was younger, and in that vein, I'm actually coming to you not from Boulder, Colorado, where I live with my wife and toddler son, but from Taormina, Sicily, of recent White Lotus fame. And so I hope that my Wi-Fi holds up. But we got to a hotel that I think has much better Wi-Fi than we've had for the last week. There have been some bad storms, so hopefully I'll be okay.
Awesome. Well, I'm gonna have to follow up with you on that baseball thing because I didn't know that about you. My son wants to do the same thing. So just quickly, for housekeeping, if this is a very open conversation, please include any questions in the chat and QA. We already have a number coming in, and everyone will get a copy of the recording afterwards. And if you have further questions, you'll see at the end also our emails if you want to email us directly, or send it to info@opexengine.com. So with that, let's kick it off. For finance professionals, change is a constant. And this is one of the conversations that we were having in our pre-calls here. And for a finance professional, you really have to be comfortable with change. And at the same time, you're staying true to the company's business targets, or whether that's growth, getting to cash flow positive, rule of 40, whatever, IPO, any of those things. And that can be a little tricky because finance people tend to like consistency and, reliability. So it's interesting. I happened to see the quote F. Scott Fitzgerald wrote, "The test of a first-rate intelligence is the ability to hold two opposing ideas in mind at the same time and still retain the ability to function." So I guess it's not just a function of our times. It's been around for a long time. But let's kick this off. And for Brian and for Evan as finance executives, how do you balance at a high level the evolving priorities of your board, your investors, the market conditions with traditional finance consistency? Evan, do you want to kick that off? Because you've got a high growth company that is dealing with a lot of change.
Sure. Well, I guess it's always, boards don't seem to be that worried about variance to the upside. In my experience, it's really semi-variance. That's the statistical definition of variance to the downside.
The dry humor there.
Yeah, volatility to the upside, people seem, and that's true in public markets as well, they seem to be fine with. So to me, I think it's all about just intellectual honesty. And that's really about how you've messaged to the board consistently. If you miss because you made a big risky bet that you knew was risky, hopefully you were intellectually honest with yourself and with the board up front. Say, hey, Project Pluto, that's a riskiest bet. It's a big prize. It's a distant dartboard, but very lucrative. And if you don't hit that dartboard, you can maintain all your credibility because you said, well, it's a distant dartboard that we're just going to take a swing at or take a shot at. So I think intellectual consistency is the key in terms of managing board expectations. The other thing I would say is like, and we talked about this in Ohio when Lauren and I were presenting, is that I think the quote from Gandhi is a correct diagnosis is 3/4 of the remedy. And so, why did you miss? Again, if people, there's a ton of people who'll take credit when you miss to the high side, but when you miss to the downside, was it bad assumptions? And if so, can you just revise the assumptions, or do you need new information? Was it bad execution? Well, maybe you need to make changes in certain key functions. Hopefully it's not the CFO function. Was it a bad strategy? Hopefully your CEO and the rest of the team, yourself included, can own that. Or was it truly a black swan event? And we've lived through a few black swan events pretty recently, but don't succumb to that seductive temptation of every time you miss, it's a black swan event. In fact, I've seen so many boards when I'm on both sides of the table. So many management teams claim that a miss was due to a black swan event. If there's not really that many black swans, I'd see a lot more of them walking around the streets of Boulder, Colorado. If you were in the hospitality space, a startup in March of 2020, okay, black swan, once in 100-year pandemic, get out of jail free. Hopefully you were able to survive. But just because your churn increased, because there was a slight increase in interest rates, that's not a black swan. You got to be honest with yourself.
Yeah, no, I think that's it. The overriding message is communication and being clear about what the risks are. And it's absolutely true. There are many mothers of success, but there only one person responsible ever for failure. Hopefully it's not oneself. Brian, what do you think about it? How do you manage that with your company?
So it's hard to not repeat everything that Evan said. Because understanding the details and understanding the why is often more important than the what. And that's where I try to anchor a lot of my conversations with executives, whether it's setting a KPI or setting a target or reforecasting. Your job as a finance leader is to facilitate conversations for decision making. And as finance people, we often anchor around metrics and numbers with like scoreboards, but not everybody thinks about things that way. And so that's where I try to meet my team in the middle and kind of translate what the goal is into kind of the why behind it and understanding the narrative behind the performance of the story. I don't know if that really answers your question, Lauren, but for me, it's like I find that I'm most additive to an organization from an operating perspective when I can facilitate a conversation about the why and make sure that we are making good decisions that we believe in, but also having the discussion that makes sure we also are all aligned behind the decision as well.
Yeah. No, I think it's communication. It's, you see companies all the time and we using benchmarks to also, provide the context for why something changed or why there was a miss, or also providing context. Benchmarks across the board can then help show that if this one thing didn't work out, where the other things are going or what's going right, and diagnosing it. So just, it's all supporting the overall communication. So I think, and Greg, I think my colleague, Greg St. James, is going to launch a poll here just to get a sense of the main sort of areas of priority for teams right now. And as we talk about that, or as people are filling out the poll, and then we'll post the results so everybody can see it, and everybody remember that it's totally anonymous. Let's talk about, just this year, 2023, there's been a lot of discussion about the shift in today's market is away from growth at all costs and more of a focus on efficient growth. And is that something a lot of companies over the last 2 years hired, because there were issues around hiring and people slowed down hiring in 2020 or got behind because of the pandemic. So then there was over hiring and got ahead of themselves in terms of their plans. And now we're in a world where every headcount has to count in terms of the cost of the headcount. Are you seeing that shift for your company of a greater focus on, efficiency and EBITDA and being cash flow positive? I'll start with Brian, maybe.
Sure. So at Tidelift, and even outside of Tidelift, I've kind of been an anomaly, I guess, is that I've always approached the finance suite with a focus on efficiency and ROI and unit economics. I've never been a believer in growth at all costs. I believe that growth has a cost, and you need to be evaluating the cost of that growth and whether it is worth it or not. Not all money is green, and so whether it's been at Tidelift or other organizations, and this has also kind of triggered my interest in OPEXEngine, where we connected learn, is that everything should be measured in some capacity, whether it's a leading or a lagging indicator, and you should be making data-driven decisions. And so whether it's looking at your sales organization and using sales efficiency metrics, or R&D efficiency, or unit economics, but to make sure that you're building a business that does scale. From my perspective, scaling an organization is a chess match, not a checkers match. You're not trying to race to the end. You're trying to think 2, 3, 4 steps ahead to make sure you're progressing in the right direction. So if you're at a Series C stage, what do you need to be at for D and E for it to make sense? Because it takes time to steer a battleship or to get a business right sized. You can't flip metrics overnight and make them look good. The business is what it is. I like this. I didn't see this headline, but I like this: growth at all costs. Not anymore. It's never been growth at all costs. It's always been growth at a reasonable cost. So eventually gravity kicks in.
Yeah, no, absolutely. Evan, maybe if you comment on that, but also it would be helpful to understand what metrics specifically you focus on when you're looking at sort of go-to-market efficiency.
Sure. I mean, I'd reiterate that, even in the halcyon days of 2017, 2018, 2019, when money was cheap and I was at a SaaS startup that was growing really fast, and great team and great product. I don't know, the CFO is always like, the story I'll tell very briefly. The CFO is always like growth at an affordable price. At least that's the mentality. And the story I always tell is that we inherited an office space from a company that, had hit some adversity. And the office manager came to me and said, do you want to do the water? They have fresh water delivered every. I said, how much is it? $55 a month. And I said, in front of everyone, tell them we'll do it for 50. And that is literally that was a waste of money, right? To have that conversation, but it sends a message to everyone else on the team that if Evan's going to try to chisel $5 a month, that they have to be reasonable about spending. So even in the halcyon days of growth at all costs, the CFO's job is always to keep those costs as low as possible. In our case, one thing that's interesting for us is that we have, 2 businesses, one in a slightly more mature industry that's still growing very quickly. And that is, the kind of more in the VFX space. That's still growing fast, but those are, typically, different ACVs. That means you have to be, very focused on, what can we spend to acquire customers? That just makes the most sense. The AI/ML world can be, much larger, very, very large step function. So the spending, it can be 2 totally different strategies, but you need to have a good handle on what can I spend to acquire customer segment X versus, customer segment Y. But either way, even in the good old days when money was 0% interest, I think we always say, think like a shareholder, think like an owner, think like, spend like the investor's money as if it were your own, because it is not infinite. And that was, sometimes hard to get through to someone who's 27 years old and had never seen a downturn before. But I'm old enough that I've seen many downturns, and hopefully I've probably seen more than I hope to see in the future. So that's why I'm always cost focused. KPI wise, like the standard stuff, I would say, Lauren. Stuff that OPEXEngine, I think, that produces for its customers, and that's, customer acquisition cost, CAC payback. Obviously, all this stuff is very assumption dependent. You have to assume that, past performance is not indicative of future results, but kind of the standard KPIs that everyone here is probably very familiar with.
Well, so you have the SaaS metrics, CAC, CLV to CAC, CAC payback, the unit economics, but then you also have all the sales productivity. There's a lot of discussion about what is the right way to measure sales productivity. And then, we like to look at, the data that we get is from finance organizations. So it is actually what companies are producing in terms of revenues and then also spending. So it's a difference between what we have versus what you sometimes see on the web, which is more kind of the heuristics or the model, like sales productivity should be everyone's selling $1 million, $1 million of new, like I saw something recently that said $1 million of new ARR per account rep. Well, we don't see, if you divided the number of account reps by new ARR, it's not averaging out to be $1 million per sales rep. And then, part of that's because we're also seeing this year, it was kind of declining last year in terms of average quota attainment in sales organizations. And I think we're starting to see this year more of a decline. And quota attainment can be kind of it's a function of what's the quota. And so you can play around with that, but it depends on how much sort of extra you have in your sales organization, because that's a cost if you're looking at it in an overall way. And I think that's why you can have companies that have kind of a poor magic number, but they say their sales productivity is $1 million per person. So I throw that out there. I don't know. I know, Evan, you got into that conversation in our last conference. How do you think about that and make sure that your model actually represents sort of reality in today's terms?
In my case, I usually, sandbag is not the term I like to use, but I don't assume that every AE is going to hit quota. As we talked about down in Ojai, the biggest miss that I've seen people make is assuming that people ramp immediately, or even if they're like saying, oh no, my model builds in a ramp period, but they say it's 90 days and it's really 180. And frankly, there's not a lot of products out there that have a true 90-day, like unless it's something so simple that it's really just a new tech veneer over a product that people are already buying. Typically the technology is sufficiently difficult to explain that unless you're the best sales rep in the world, you're not hitting quota day 91 in my experience. So, over aggressive ramp times or non-existent ramp times, that's an issue. I usually sandbag it at around 75%. So I'm curious what OPEXEngine sees. It's very standard SaaS metric is 100 base, 100 OTE, 5x on that OTE of 200. So $1 million quota is what I've seen. Maybe OPEXEngine seeing something different, but I would expect that it's like kind of 750K per average. But you don't have to give away the secret sauce for free, Laura. I'm not trying to get you to throw out freebies. But yeah, so that's how I usually model it. In terms of KPIs, like for sales efficiency, there are all sorts of advanced stats out there in baseball, for example. But and a lot of the old ones are really imperfect. But like batting average and home runs, actually, it doesn't tell the whole story. Don't get me wrong. But you can still kind of look at batting average and home runs. So for me, okay, what percentage of reps are hitting quota? It's not perfect. It will be distorted by outlet, but that's like the batting average and home runs of sales efficiency. It doesn't tell the full picture. Don't get me wrong. And I'm an analytical guy, so I know the shortcomings of that. But it's not a bad starting place. So
I love that, the comparison of SaaS metrics with hitting records and home runs. That's fabulous. So Brian, it's a great question. as a CFO, you're responsible both for presenting the numbers upward, whether that's to the board or to investors, but at the same, and sort of the model, but then you're also responsible for reality. How do you advise FP&A folks on, your team on, how do you account for ramp times? How do you account for productivity and really model it correctly so you know what the forecast is? And I think you're on, yeah.
Yeah, sorry, I was muted. I have a dog barking in the background, so I was trying to stay on mute.
I know the feeling.
Yeah, I mean, in my experience, not properly accounting for attainment and ramp rates is the biggest bogey in most models, especially people that are new to forecasting. If you're coming to it either from the accounting world or a former banker or, God forbid, a PE person, you're building tops down models, but the real operating model, you've got to look at how quickly your reps are ramping and what rep productivity looks like. And I've seen many models get broken because someone was like, oh, we had enough butts and seats in the model. Why aren't they hitting the number? And you forgot to account for the fact that it takes 5 to 6 months for an average rep at a well-established, high-functioning sales team to hit their number. But that first part is key. If you're early stage or high growth, it could take 6 to 8 months, or I've seen it take up to 12 months for a ramp to get productive and start getting their number. And then even still, typically only 2 out of 3 reps hits their number. So, and that's coming to this from a higher ACV business model, which is another thing that gets lost when you take the heuristics or the benchmarks without context, looking at it for industry or ACV or business stage, because those are all things that can dictate kind of like how a typical rep is ramping in your space. And so I would just encourage people out there to make sure they account for the time it takes for those things to pay back, but then also the same is true even for CAC. I remember when I feel like it was trendy a couple of years ago to show a model with CACs decreasing as you scale and grow. And I've seen the exact inverse relationship at every startup I've been at. The larger you grow, the more CAC tends to go up. And that just has to do with it being harder to identify and target leads, harder to sometimes close deals. It tends to feel like you're going up a slow grade. And that usually means you're doing something right. It doesn't come down like many think.
Yeah. I think that's one of the really interesting things about the SaaS space is that, because I came from traditional software 20 years ago, and the traditional, in the first place, traditional companies are run by P&L, just sort of income statement. As you get bigger, sales and marketing expense goes down, R&D goes down, profit margins go up. It's just like a really nice sequential kind of thing. Whereas in SaaS, it's not linear. Your costs can go down and then you get bigger and they go up because you're expanding internationally. You have higher security requirements. You're moving from selling 1 product to 3 products to 10 products. And you have to build out new departments. We typically see, CAC may not go down until you're over 100 million. It does go down eventually when you get some scale, but on the other hand, it doesn't keep going down the way people think it would, because the technologies get more complicated. The technologies, the support for each of your organizations, your sales support, sales enablement, your sales organization is just a lot more overhead and complexity as you get bigger. So it is pretty interesting in terms of being able to model that, which is why I think benchmarking really helps you, because you can see what to expect as you're planning, and you can benchmark for 1 year ahead, 2 years ahead, 3 years ahead, so that you're not running behind on those kind of things. The other area that I think is really important to talk about in terms of go-to-market efficiency is retention rates. I wrote a blog recently that was saying that I think as an industry, we kind of over-indexed on net dollar retention or net revenue retention, if you want to not be sort of US centric. And, you know, it's just investors got really caught up in it. And suddenly everybody wanted to be Snowflake with like 180% net dollar retention, which if you're selling in the SMB companies do not regularly, you know, buy a product and increase their spend on it by 20, 40, 50% every year. It just doesn't happen. And not all companies can keep doing that. And I think it's just like sales comp plans, I like to say, because in a sales comp plan, if you have like one metric that you tie your salespeople to, you will have unintended consequences, no matter what it is. So if you totally focus on net dollar retention, for example, I bet you that you will find that you will have salespeople who might ignore customer satisfaction, or customers who don't expand, they won't get focused on. And if you focus only on customer retention, then you might have a lot of discounting going on just to keep them in place. So that's why, I mean, I think it's incredibly important that you have a group of metrics. You have net dollar retention, you have customer retention, which tells you whether you have customer groups that maybe in this market are not working out so well, but you still have sales resources tied to them. And then gross dollar retention that tells you if either your customers are retracting or you're discounting in your sales organization, you need to get on top of that. But is that something, do you have any pushback, or do you agree with me that you should be tracking all three? And then do you have pushback in your organization on looking at it that way? I guess I'll start with you, Brian, and then I'll go to Evan.
Sure. So I fully agree. I think we're in a safe space, though we're likely to agree with you on this one, Lauren. I don't know if you mentioned this in kind of the pre-call, Evan, or if I imagined it or I suggested it, but the idea that metrics should be looked at in terms of like a stool, where you should, whatever you're measuring, you should try to unpack it in a couple of different ways. Just looking at one solitary metric is going to eliminate a lot of the noise where all the interesting information is going on in the business. And so if you're just looking at ARR, or you're just looking at bookings, or just looking at net dollar retention, you're going to miss all the gory details behind it. Ending ARR is a great example. It's not what you were talking about there, Lauren, but I think it's a really good example where when companies focus on ending ARR, you miss all the new lands, the expands, the contractions, the churns, and those movements are more important than the ending number. Boards might disagree with that, but I think us as operators get the why there, because understanding what's going on in your business kind of helps you anticipate where things are going. And the same thing could be said from a retention perspective, looking at net dollar retention, but also looking at gross retention, looking at churn, contraction, unpacking the metric in a couple of different ways, and doing so in a way that makes sense for your business and your business model. To go one step further, you mentioned paying reps on something and they'll kind of manage that number. One thing I've tossed out with our CRO, and we're going to explore as the business scales, is adding another driver to our comp plans. So in addition to just being a dollar delivery, whether it's ARR, bookings, or some sort of some new delivery number, having a retention component as well, so that the reps do have to think about deals that are good for the business, deals that are likely to stay around, whether it's an onboarding driver or a retention driver or an expansion, but some sort of secondary lever, so that way it's not just growth at all costs.
Yeah, no, I mean, it is interesting, and obviously anything you add to a sales comp plan has to be carefully looked at. Evan, did you have thoughts on that in terms of, and I'd also like to add to that question. There's a question that's just come into the Q&A about who owns revenue forecasting and relevant assumptions around AE SDR ramp times, because that's a perennial organizational question. Is that in sales? Is that in finance? Or do you have some kind of rev ops in some independent organization? What have you seen around that?
You take your last question first. I'd say it has to be a joint collaboration between sales and finance. And at the end of the day, you can set the best ground rules or mechanism or voting or decision making. But if you don't have good faith, it doesn't matter. And if you do have good faith, it probably doesn't matter either. If you have I'm working right now with the best head of sales I've ever worked with. He's a high integrity person. And guess what? Shocker. Not only are the results there on the sales side, but the comp plans is pretty easy. I've worked with ones that were not that good. And guess what? Every forecast, every comp plan was a knockdown, drag them out, war just to try to to try to push the quota as low as possible, just single-minded, So at the end of the day, if you don't have the right person in the in the sales chair, frankly, the same as let's put ourselves in the salesperson or the sales leader seat. If you have a CFO who just wants to keep jacking the growth rate quota beyond what's reasonable, then that doesn't matter. Good faith and bad faith cuts both ways, both sales and finance. So I think it has to be a collaborative effort. In terms of which ones to track, should you look at all three? I think the answer is absolutely yes. In terms of whether it's net dollar retention, logo retention, every aspect. I think Silicon Valley falls in love with its winners, right? And they love to just overlearn from those. So it was so de rigueur to say, oh, Facebook realized that it was 7 friends in 10 days or 10 friends in 7. I don't know, it doesn't matter. And so it was you just need your North Star metric. There's one star that you Polaris that you chase, and as long as you take care of that, that's fine. That's true when you're 10 people in a garage, probably. But after a certain point, the real CEOs love that because Facebook, man, what a success. But truth is, let's be keep it simple, stupid. Focus on one thing. Sorry, the world's more complicated than that. But as one participant pointed out, you can't comp on 5 things or 6 things. I think there's research by the Corporate Executive Board. Sorry, I don't know if they're a competitor. Lauren, I'm good.
They're good. They're good.
Boo to Corporate Executive Board. Big ups to the OPEXEngine. But they did some research once that I forget if it was 30% or 35%, but that if you had a metric in someone's comp plan that was less than 30% or 35% of the comp, people just didn't manage to. There's boundaries on cognition. There's limited rationality. They can only focus on so many things at once. And if the number's 35, then guess what? That really means you only have 2. But there's 2 different things there. It's writing a good comp plan. There's no perfect comp plan. You just get it close enough for that people are doing the right things, right? You probably can comp on 2 things, but that doesn't mean that the CFO and the CEO and the rest of the management team shouldn't be looking at a multiplicity of things. It's just how you manage the business and how an AE or account manager manages their book of business. Those have to align, but they do not have to be identical, nor should they be.
Yeah. I mean, having been head of sales at a number of companies, I am a strong believer in having hired. It can't just be focused on the comp plan. You have to manage sales and manage hire salespeople who are going to do the right thing for the company. Obviously, they have to be, motivated and good salespeople and focused on earning the money. But at the same time, if you're hiring people, I won't name the name of, some big tech companies that, didn't always hire ethical salespeople, but they eventually got in trouble. It just, what goes around comes around in many ways in this world. So I think also it's interesting, we have some questions on, sales productivity gets all the focus, but marketing also gets a lot of money. And in general, in the benchmarks, enterprise sales, big ACV, you spend a little more in sales than you do in marketing. In smaller ACV, you tend to spend more in marketing because you have to, put a lot out there. And an interesting sort of different cut on that is that what we see in PLG companies versus non-PLG companies, because there's so much hype about PLG, is that PLG is from what we see, is a really expensive model to get started with, which is maybe why investors really like that model, because it's taken a lot of money. And when you get to about 100 million, it's like great, and you have better metrics. But particularly PLG also has to have a lot of marketing, because viral growth in this world doesn't happen without a lot of like marketing manipulation to make that happen. So coming back to each of your businesses, how do you best assess the return on marketing spend? I mean, I'll just say from our perspective, we focus on, magic number telling you kind of where you're at, and then you have to dig into sales separately from marketing. And one of the key metrics that we benchmark that I really like, because it's totally quantifiable, is just marketing qualified leads at the top of the funnel and number of closes. And everything else, everybody does differently, everything in between. But all I want to see is, am I in this, for my particular model, am I on par with other companies? But everybody's got different ways of looking at it. What do you think, Evan?
I think it's hard. It's really hard. I mean, there were a bunch of software tools that some of which we used at a previous company that tried to solve the fundamental attribution. And it was usually first touch, but I think most companies still use first touch attribution, but we all know that's nonsense. Someone might have received an email 3 years ago and then attended a conference or had an outreach, outbound call. It's incredibly complex and imperfect. And the old chestnut of, I know half of my marketing spend is valuable and the other half is wasted. I just don't know which is which. Like, unfortunately, that's true. Whoever comes up with the software tool that actually does solve that is going to be a very, very wealthy man or woman. And I just don't think that person has been born yet. Honestly, all you can do is the best you can do. This is a terribly unsatisfying answer, but it's a terribly unsatisfying problem. This is not something we've answered. I think as a business culture, attribution is hard, and and so how to evaluate you have your like direct spend and indirect spend, but obviously only allocating spend to the indirect spend, only allocating leads or qualified leads or opportunities, however you want to. And the further up the funnel you are, obviously, the more of frankly, a guessing game it is. It's just hard. I don't know. I'm sorry, I don't have a better answer, but you have to, like, the best way to do it, in my experience, is benchmark it against your peers to the extent that that information is available, and benchmark it against yourself historically. So it's hard to tell if we know we're doing a great job, but we can know for sure that we're doing a better job than we were last year or a worse job than we were last year. But the rest it's hard, man.
I appreciate your being honest. I mean, it is hard. And I think the hardest thing is that so many of the metrics are just about activity and not tying the activity to productivity. Brian, what do you think?
I would echo your point, Evan, that attribution is incredibly hard. But I would question, this is going to sound crazy, I would almost question the value of solving that, because it might discourage experimentation and creativity. Because so much of early stage and growth SaaS is just trying a bunch of shit. Sorry for my language, but trying a bunch of shit and seeing what sticks and what works. And it's hard to measure the stuff that doesn't work, because how do you attribute that? Do you have like some sort of like R&D for marketing budget? Every like board member would say, "Oh, cut that. We don't need to do R&D in marketing." But the reality is that you are experimenting with how do we grow and how do we identify new channels. And it's really tricky. But I do like what you suggested at the beginning, Lauren, around simplifying around MQLs. Was it MQLs or MALs? Either one.
MQLs to
okay.
Close business, just because
Yeah.
Usually you can count your MQLs and you can count your closed business. If you can't, then you've got bigger trouble. And it's just, you can also look at the velocity, like how long it takes and that kind of thing, but just the numbers, because effectively a marketing organization is paying for getting qualified leads, and they're paying to support the sales organization to close business. I mean, I think that's, you could talk about branding but at the end of the day, you're doing that to sell. So
Yes.
I like to keep it simple.
Yeah. I've maybe gone to one more degree of complexity, but also keeping it very simple. Most models that I build focus on going to leads, MQLs, SALs, opportunity creation, and opportunity close. I always have those 5 layers to the funnel. And one thing I've done recently, we're running an experiment this year to add a lever of incentive comp for the marketing team and paying them based on sales accepted leads as opposed to just leads. And so it's what that's creating, and we're seeing it happen real time this year, is it's creating a forcing function for a conversation between marketing and sales. The marketing, for the longest time, as most marketing organizations, they're like, oh, I created 30,000 leads over the past year. What's going on? Why is it sales closing deals? Well, it's because none of those found their way through the funnel and became SALs. They were generating all these leads, but they might have been for the wrong personas or wrong industries or wrong verticals or for whatever case, or spammy leads, because there are lead services out there that will sell you leads. And so we're trying this year. I'd never done it in the past, but I noticed such a block or like a divide between the sales and marketing function, where we decided to run an experiment and add a small slice of incentive compensation for the marketing team, for the whole marketing team, and they get paid on some number of SALs that are accepted by the sales org. And kind of hold them accountable, hold their feet to the fire a little bit. And they were actually really excited about it. They were like, oh, we love this. I have a very data-driven marketing team.
You got to let us know how that works.
I will.
So we're getting closer to the top of the hour. I do want to ask one last question that's been in here. And then I also want to talk about benchmarking, obviously, near and dear to my heart. But a really interesting question and very topical. Can we use AI tools and bots in finance and across the company to improve efficiency and manage costs? What tools are people using now and having good results? Really interesting question from a variety of levels. But Evan, what do you think about that?
Well, I'm happy to be a little bit of the butt of the joke here because my company powers a lot of AI companies, and I know I'm going to be not a Luddite, but maybe a little bit a laggard here. I think AI offers tremendous opportunities in certain things like automating customer success, and everyone's already aware of that. Well ahead of their time, TD Ameritrade, built, I think it was called TED, and it's like an automated thing that frankly, good for them for doing it in such a highly regulated environment where the securities industry, they managed to make it work. I know that it will happen in the healthcare space eventually, but now you're starting to talk about HIPAA and the downsides to getting an answer wrong are like pretty high in that industry. So that's where I think you'll see it start. Looking inwardly at our own industry, I know that there are a ton of really routine tasks that could be automated through AI in terms of bank reconciliations, credit card reconciliations, and already some of the tools that we use. For example, we use Ramp, not to buzz market Ramp, but I feel like they're a pretty good tool. Their engine, such as it is, already makes guesses as to what expenses are to try to match it. Some of that's just database querying, but also based on the size, I think the size of the transaction and time of day, it like sort of does a little bit of kind of fuzzy AI, is my understanding anyway. But I just know that because the price of being wrong is so high, this is not like a sophomore year medieval studies term paper where you can run it through ChatGPT, and if you get a B- or a C+, that's fine. But like I will be slow to adopt because of the sensitivity of the information. and because of the price of being wrong. I think I will see it be adopted elsewhere in the org faster, but that's just me. And I totally deserve to get made fun of for that answer.
We won't tell your customers. Brian, what do you think?
So I'm likely still more of a Luddite, but not as much as Evan. I actually had a conversation a couple of weeks ago with a group of CFOs about this specific topic where I was the Evan of the conversation. And the other person on the call was like, oh, we should all be using AI, ChatGPT any way we can. And we talked through it live on the call. And the happy middle ground we came to was that this is happening. The train hasn't just left the station. It's out the door and on the way. And so we really despite all the risks, I get it. There's data risks, there's privacy, there's security, there's giving proprietary information back to an algorithm. There are all those risks. But at the same time, it's happening. The wave is already moving its way across the ocean, and we're going to need to figure out ways in which we can leverage the quickly evolving technologies and ways to work smarter, not harder. Because otherwise, we're just going to work ourselves out of a job and just be stuck holding an empty bag in 2, 3, 4, 5 years, however long you think it's going to take for this thing to really kind of gain more momentum. So one thing I've done is oh, sorry, Evan, go ahead.
No, please. Sorry, I interrupted.
One thing I've done is I've just tried finding ways in which I can use, whether it's OpenAI or Baird or any of those tools, ways to kind of augment some of my day-to-day work, whether it's researching a job description or doing some summarizing some sort of public piece of information, trying to find ways to creatively engage with some of these technologies so I can at least stay on top of how they work and how to kind of optimize the results, being full aware of the fact that they could provide wrong information. I was reading a blog post the other day where ChatGPT said 1 was greater than 4. And sometimes it said 4 was greater than 1, and depended on how you asked the question and the order of the words. And it was getting way too deep on 1 and 4. So it can be wrong. It also I lost my thread. But I just think you need to kind of go into it eyes wide open and figure out ways that you can use it to work harder. But the other thing that concerns me about it, kind of putting the Luddite hat on, is the cost to one's development. That it could make people lazy if we become, as human beings, we could become lazy and too dependent on it, and get lazy about reasoning and research, things that many of us did early in our career, where you had to go and read an S1 and synthesize the results. There's value in doing that research exercise, or pulling 10Ks and understanding the footnotes for how they account for software development costs at the different organizations. Sure, ChatGPT could do that for you, but there's value in being able to read a financial statement and understand where to go and how to synthesize that information. And my fear is that some of those skills will get lost if we're not intentional about it.
Kind of like when you have a babysitter coming over and they're 2 hours late because their GPS didn't work and they can't find your house. And they can't, even though they've been there before, but they never actually looked at what they were doing, or they can't read a map.
Or know what the street signs are. They just turn right when they're supposed to turn right. Having a sense of geography.
Exactly.
Go to a city and get lost and put your phone away.
No, this is great. So I think we have to start wrapping up a little bit, and we could definitely talk about AI and ChatGPT till the dogs come home. I'll just mention my biggest concern there is that people, and especially I would say 20-somethings, don't remember that everything that you ask an AI system is remembered, and that they can make inferences based on what you ask. So you're giving information as much as you're getting information, and people forget that. But to Evan's point, I think the opportunity for automation is awesome. I'm part of a Boston CTO group, and there's been just some amazing conversations about ChatGPT, and just, people using it for programming, routine programming things that you don't want to spend your time doing. It's just amazing. So talking about, the different ways in terms of applying benchmarks to your budgeting and planning, especially as things are evolving and as you're really focusing on an efficiency, we see people using benchmarks in a couple of different ways, but I'd be interested in your thoughts about how you use them in your company. One is, sort of the difference with benchmarking with OPEXEngine is that we work directly with finance organizations. So we're taking their metrics in our structure, and we're working together with them to make sure that, because everybody's data who goes into the system goes through the same process. So it's an apples to apples comparison. So if you're talking about sales productivity, it's the same sales product, measurement from company to company, so that when you go to use the benchmarks in a conversation with the head of sales, you're not arguing about, well, that's a different benchmark because it doesn't really apply to what we're calling sales productivity, because we look at sales productivity this way, and you, Mr. or Ms. CFO, are much more conservative about how you measure sales productivity, and that's why we're not on the benchmark. Whereas, it's important to just eliminate that conversation, but then also the issue of budgeting and planning, and then also digging in specifically to various areas if you're trying to figure out productivity. And to the original point that we had in this webinar, which is it's all about communication, communication with the board, communication with the other executive team. So tell me a little bit about how you use benchmarks in your company, Evan, and we'll just wrap up with that.
It's something we need to do more of, candidly, because of the size of the two being kind of totally different types of customers, the way that they buy. We need to get a little smarter.
Need to break it apart a little bit.
Yeah, and we literally just hired your first FP&A hire, then immediately went through a transaction that was announced. So it's like time to level up that kind of stuff. Something that I've always had really, it's one of the things that I really enjoy doing as part of the CFO job. There's a bunch of things I don't enjoy, but that's one I really do enjoy. One thing that's tricky is, in our space, like, you can't really get comps on other cloud providers because there's no pure play cloud provider out there. You could look at Amazon's financials. Good luck, breaking out AWS. Good luck breaking out GCP from the 10 million products that Google sells, or Azure from Microsoft. So it's tricky. But that's where the fun is in the CFO job. I bet Brian has a way better answer.
We've been there. So Brian, how do you use benchmarks and how do you compare your benchmarks with maybe what investors say should be the benchmark?
So the way I've come up with benchmarks,
like your investors, and your investors give you good benchmarks.
That's funny. It's only funny because remind me offline. I've got a story for you about a conversation I had with one of our board members about benchmarks at our last board meeting. But a lot of the benchmarks I use, I hate to say this on an OPEXEngine call, but are informed by just real firsthand experience, having run finance at similar businesses for the past 15 years. That I've worked at a number of DevOps companies and DevSecOps companies selling with the enterprise sales motion from the A through the C stage. And so I have just firsthand intuition about a lot of these just general heuristics from what I've seen firsthand. So it's all up here, which is the sad truth of it. But I also just try to read as much as I can and leverage all the studies that do go around and try to kind of make sure that I'm looking at a relevant data set. And so when I'm building my models, I try to keep the overall benchmarks in mind when I'm forecasting out a model and looking at our performance, both past and forward looking, understanding that we're not always going to be at the number, but understanding where we're off and why we're off and where we are in the journey. But I do a lot of my forecasting and modeling rooted in kind of keeping in mind what the overall benchmark is. So you don't like, you're working on your model, but I also maintain kind of an overlay of where should we be trying to get to, understanding that we won't be at that number today.
Yeah.
I don't know if that answers your question, Lauren, but that's kind of how I approach forecasting day to day at Tidelift.
Yeah, no, I think that makes sense. And I mean, many of the companies that we work with are using various sources of benchmarks. And, you know, we're a third-party independent platform, and, you know, we've have a very well-established big independent database. But, you know, I think I would be the last person to say, you know, only use one piece of information. You absolutely want to make sure that you're using as much information as possible to make sure you're getting to the right answers. It's all about being data-driven. So with that, I want to wrap up and just thank our panelists, Evan and Brian, and thank you so much. This is a great conversation. To be continued. Thanks, both of you.
Thank you. This was fun.
Take care, everybody. Thank you for all
my pleasure.
participants.